All right, good afternoon, everybody. I'm David Lowenthal coming to you today with a video edition of the NASDAQ Corporate Solutions Advisory Squawk Box. I wanted to take a few minutes today to talk to you about the upcoming 2Q earnings season. Of course, we have Alcoa releasing results, kicking things off unofficially for the second quarter on July 8th, right after the July 4th holiday. You know, I had mentioned it on Monday's Squawk Box. We talked a little bit about the correlation between the rising stock market and also corporate earnings, rising corporate earnings. So from the March 2009 lows to the end of last year, the S&P 500 index has risen about 114%. Now, meanwhile, it might just be a coincidence, but at the same time, trailing earnings have grown at about 116%. So very tight correlation between the two. Now, the problem is that unlike 2010, 2011, and last year, earnings growth has really ground to a halt. Now, you have Wall Street consensus really expecting little profit growth for the upcoming quarter. It's been pretty ugly so far. Earnings pre-announcement thus far have been running at about a 7-to-1 negative to positive ratio. This is the worst level that we've seen since the first quarter of 2009. Now, the blame, of course, is still on a very weak Eurozone environment, moderating growth out of China, but keep in mind that we're still running at a 1 to 2% GDP growth rate. And, of course, earlier this week, first quarter GDP growth was revised downward, so it just goes to show how tough an environment has been for corporations. Now, one additional point that I wanted to make note of today, as far as concerns around earnings growth, has to do specifically with company buybacks and a rising interest rate environment that we might currently be in. Now, many would argue that a major contributor to the earnings per share increase over the last several years has been from a reduction of share totals due to stock buybacks, funded in large part, of course, to the rock bottom interest rates that we've seen courtesy of the Federal Reserve. Now, flush with this fresh cash, companies have decided to buy back shares at a record pace over the last several years. This last year alone, for example, U.S. companies have given authorization to buy back almost $300 billion worth of their company's stock. Now, this is up almost 90%, 88% specifically from the same period last year, and this is, again, the highest level in 5 years. Now, the thought process from corporate executives has been that if you can't get earnings per share growth through organic means, through profits, then you should do so by reducing the number of shares in issue. Now, many market participants and executives believe that since repurchases reduce the number of shares outstanding, thus increasing EPS, it would also raise the stock's share price. Now, take Apple, for instance, made major headlines just a few months ago. Its stock has clearly suffered this year, is down dramatically year to date. Now, just before interest rates started rising towards the end of April, Apple issued an astounding $17 billion worth in bonds for the sole purpose of buying back its company stock. Now, the problem comes when interest rates start to rise, as we've recently seen. Corporate bonds will obviously tank in value, but more importantly, it'll be incredibly harder to fund these share buybacks. Now, if interest rates rise faster than the economy recovers, companies will be forced to discontinue borrowing money to buy back company stock. While this would not increase the volume of shares outstanding, it would eliminate a source of shrinking volume, which would make companies more dependent on business conditions to increase profits. Now, just 1 month ago, as rates started rising, Dole Corporation actually did suspend its buyback program in what could be the start of a new trend. Now, Dole announced the indefinite suspension of its previously announced share repurchase of about $200 million of its outstanding common stock. Now, although Dole did not explicitly cite rising interest rates, it could signal a change in use of cash as the funding environment has changed. But what I wanted to also point out is that perhaps more interesting on our side would be the impact on current shareholders. Now, I have in front of me right here an article from this past Tuesday, June 25th. Scout Capital Management, which is a U.S. hedge fund, said on Tuesday that it is urging Canadian coffee and donut chain Tim Hortons to increase its debt levels in order to fund a share buyback. Measures that Scout say should help drive up Tim Hortons' share price by as much as 100% from current levels. Now, the demands to Tim Hortons' board by Scout Capital Management are also similar to those put forward by rival U.S. hedge fund Highfields Capital Management earlier this year. So we could see this new surge in activism from traditionally non-activist funds urging companies to take on increased leverage to continue to fund these buybacks. Again, earnings will be squarely in focus after the 4th of July holiday. We will, of course, be closely monitoring comments around buybacks and dividends and any comments from shareholders on these matters as corporations also react to pressure from rising interest rates. So please let us know if NASDAQ Corporate Solutions can help you with questions around uses of cash in this current rising interest rate environment. Thank you. Have a good day.